Hello, I'm Dave Brinkman, partner in the wealth management practice in Columbus, and I'm joined by our Chief Investment Officer, Jason Staley, and we are filming this on Sunday afternoon, coming off of a very volatile week. And Jason, maybe as a segue, I'll bring you into the conversation here. For the audience here, let's kind of big picture hit on what is a very active week towards the tail end of February here.
Yeah, I think that this has been, certainly, land invasion in Europe. You kind of have to go back to the early 40s in World War II for something to get some kind of a historical parallel. So I think for that, certainly taking a step back, it's our thoughts and prayers are with, the Ukrainian people. Certainly are under siege, but it seems like from all accounts are holding their own. And, obviously there's going to be a big humanitarian fallout, but just it's obviously war is awful. And I think that might be the most gross understatement you'll ever hear me say, but it's a terrible thing. There's going to be a big humanitarian mess to clean up, and hopefully, we're up to the task, from a global population to help, settle this thing down and get people back, to where they came from. But it was certainly, I think, kind of taking, a step back from the humanitarian crisis and moving forward. Russia telegraphed this. They had moved, a third of their armed forces to the border of Ukraine over the last several weeks. And there was speculation about whether that they could draw down. But I think some of the market volatility that you saw was certainly the market pricing in that you could see some action, maybe similar to what they did in Georgia in 2008 or in Crimea in 2014. Obviously, this significantly surpasses that. But I think the market was expecting something to happen. A large-scale invasion of Ukraine, maybe not, right. But as we saw, and I think you and I are going to get into it, the large-scale invasion of Ukraine and kind of what that meant a lot of different things depending on what time of the day you were looking at the market.
For the audience, let me add some just capital market numbers to kind of what you were alluding to. So we saw a nice rebound on Friday, but so factoring in the if you're looking at the S&P 500, a 2% plus day on Friday. So as we sit here today, not factoring in futures on Monday's open or anything like that, we're sitting at just shy of correction territory on the S&P 500. So maybe for the audience, what is correction territory? Correction territory is basically a 10% decline from the most recent highs. So we're just shy of that. We're at about a 9% drawdown on the S&P 5. You look at the NASDAQ, you are squarely in correction territory. You're off about 16%. Bear market territory would be you're off 20% from the most recent highs. You can find bear market territory right now in small cap growth as an example, right? And these things always fluctuate, but just giving some context for the audience. And, we're just shy of correction territory if you look at international and probably right 16% on emerging markets. So maybe, Jason, is it just Russia-Ukraine that's leading to these drawdowns, or there's more to it than just this recent geopolitical turmoil?
Yes, absolutely right, Dave. And I think that's a really good summary. And when we talk about, depending on what time of the day of the market you look at, on Thursday morning, the NASDAQ opened up down 3%, which almost put it like if it didn't touch 20% kind of in the bear market, I mean, we're talking really close.
Right.
And then it rallied all the way back and finished up like a 1.5%, 2% on Thursday. But I think taking a step back, really what was driving the downward trend in markets that predated the encircling of Ukraine by Russian armed forces, what was this idea that we were, the interest rate environment was going to be dramatically different in the U.S. You had the Federal Reserve will stop their quantitative easing program, which means they're going to stop buying bonds in March. The last purchase they made in February, that will be the last part, or at least from what they've announced. And then you have, the Fed indicating they're going to be particularly hawkish on battling inflation. And really this higher, stickier inflation is what's causing the Fed to have to do end their quantitative easing program more quickly than they would have liked, and to raise interest rates, quite frankly, sooner than they would have liked. And so you have this prospect of higher interest rates and higher inflation. And then as you look forward, what you also have is a slowing growth environment, which we were likely to get anyway, because all of the fiscal and monetary stimulus that happened post-COVID of March of 2020, that was all burning off. President Biden was only able to get the infrastructure bill passed. The larger, more substantive, fiscal package was shot down by Senator Manchin of West Virginia
right.
in November of 2021. So when you think about that, all of the tailwinds that were providing this rocket fuel for equity markets were all of a sudden being taken away. And the market was trying to say, like, okay, well, where do we value certain stocks, like these growth stocks that have all of their cash flows in the future? Well, if rates are going up and we discount those same cash flows back, they're worth less now because interest rates are going up, and then you also have this slowing growth environment. So that trio of higher interest rates, higher inflation, lower growth, that had more to do with where we find ourselves now. And if you look at where the S&P is now, we're right where we were a week ago. It's not, we're down about 8-9% on the S&P 500. Like, this is right where we were. And we kind of have greater clarity about what's going on in the Ukraine and Russia, at least 4 days in. And I think so then you kind of remove that, from the equation, and then you come back to this rates, inflation, and growth narrative that I think the market is still trying to work its way through, and that's what's really driving a lot of the price action that we've seen year to date.
Well, half kidding. What you've just said is it's really hard to be a short-term investor, because in the span of a week, we've seen things that, and it's funny. You can go back to the end of December and somebody's got the best prediction of the world of what 2022 is, and it's already basically blown up, right? It's like we're not even 2 months into the year yet, and whatever you thought this year was going to look like, you probably didn't see the geopolitical risk flaring up as quickly as we have.
No, so, not even close. And I would say, to your point about it being blown up,
that's a poor analogy, by the way.
Well, no,
using that word "blown up." Yeah, it's a bad analogy.
But think about it. We were talking about raising interest rates in November and December of last year. Inflation's gotten modestly higher, but still, it was 7% in December. It was 7.5%. I think annualized CPI whenever they came out. I mean, yeah, that's a jump, but it's still we're still seven handles.
What you've seen the price of oil, obviously, you could see inflation continue to run hot just with oil approaching 100 a barrel, right?
Yes, yeah, absolutely. And I think that those are the same things that the market ignored when it just started going vertical in December, and you're trying to find a reason. You're looking at these things, and it's just maybe the market didn't think that the Fed was ever going to raise. Maybe they thought that the inflation was going to be more transitory. But where we find ourselves now is that supply chains are likely to continue to be constrained as a fallout from this Russia's invasion of Ukraine.
Right.
To your point about energy prices, if the sanctions go on a lot of these Russian energy companies, that's going to cause further pressure on energy markets, right, and on kind of supply and demand. So there's certainly the things that were driving the inflation, the inflation conundrum that we found ourselves in have been exacerbated. But it's not like they weren't there in December. Right. It's just the market right now is starting to pay attention to them. And I think it's the market starting to pay attention to them because you're seeing companies report their fourth quarter results, and then they're discussing the future, right? They're discussing how 2022 is going to look. The forward guidance, Dave, think back to your time as an equity research analyst at William Blair. You're sort of concerned about the prior quarter's earnings because you want to make sure that your models look good. But as an analyst, you were way more concerned about what they were saying about the forward guidance, right?
Forward, what their concerns are on the horizon. Yeah, all of those were key factors.
And the way the companies are guiding, they're saying it's going to be a much more challenging environment. And as the companies are lending credence to higher rates and higher inflation are going to start to eat into profit margins, I think the market's certainly starting to react. And then you've just had, you've had some of the big mega cap tech names, whether it's Google or Microsoft or Amazon, who are giving very good, or to good to very good earnings results, or kind of forward guidance, but it's not perfect. And when you have a market that's priced perfectly and you don't get perfection, you're going to have some risk to the downside.
Well, and you've seen the haircuts, right? If you just look at the NASDAQ, right, and the underlying components of it. So, I mean, I think what we're ultimately talking about is the market's always discounting and forward looking, right? And that gets, as expectations build, that perfect market that you're highlighting, it's healthy and normal. I think that's the other thing, right? That we didn't have a lot of this, and after you got through the COVID sell-off in Q1, Q2, basically up into the right, 21, very limited volatility. So I think that's the other thing that people have gotten comfortable with the market that really didn't have much volatility, but that historically has not been capital markets, generally speaking.
No, you've certainly seen more volatility, historically. And I think, we talked about the historic and kind of unprecedented monetary and fiscal stimulus that really went into the system, that kind of really primed the pump to get us out of that. So, those things lend themselves to, to kind of less volatility. And now that those things are being taken away, those tools are getting put back into the toolbox. Now we're kind of getting back to a more reasonable state, which is, hey, listen, 10% corrections happen typically once or twice a year. A bear market, kind of down 20% happens kind of every 5, 6, 7 years. I mean, these are things that are well within within the realm of acceptable outcomes, historically, in terms of how these things occur. But we just haven't had to deal with them. And I think when you talk about emotional biases, right, there's this thing called recency bias, where you tend to overweight things that have happened more recently, and you discount the things that have happened far in the past. And so I think that investors are working their way through some of the psychological aspects and behavioral aspects of investing that, to your point, make short-term investing so stinking hard.
And maybe let's go there as our final thought to the audience. We've spent a lot of time, around emotional intelligence and, behavioral finance as an investor, just because we've seen the outsized impact it has over extended periods of time when you look at the average investor's rate of return. So maybe, look, the last week, and I don't mean to make light of any of this, but inflation, interest rates, Russia, Ukraine, there's a lot of uncertainty as to how exactly this plays out. Maybe some final thoughts for the audience as advisors. And let's say you're uncertain, right? Actually, look, I have no idea how the rest of 2022 is going to play out. That's about the only thing I'm certain of. So how should investors react or not react, and give us a little bit more around how do you process this and ultimately make investment decisions from it?
Yeah, I think in a note that went out to our clients Thursday morning, we talked about one, having diversified portfolio. You have diversified portfolios because of this exact occurrence. You never know when Russia's going to invade Ukraine in the way that they've invaded Ukraine, right? Because the last 2 times they did it, it was completely different.
Right.
And you have things like core fixed income and real assets, infrastructure, farmland, timberland, high quality commercial real estate in your portfolio for these times. They serve as the ballast of your portfolio, so that when you do see markets, giving you this, right, this movement up and down, you have something to point to, saying, okay, that's the reason why I own that. It's going to help me. It's going to help the riskier parts of my portfolio, give them time to heal. And I think when you're so uncertain and you don't know what is going to happen next, sometimes the best thing you can do is just sit on your hands, not do anything. And what we would say is, and then the next thing to do is call your advisor and have a conversation, so they can point out and reassure you, well, you have this, you have this much in core fixed income, you have this much in real assets. Your advisor is able to kind of help, bring knowledge and rationality into what is, at times, it is a normal occurrence. And I can't stress this enough. I stayed up late into the night on Wednesday evening, Thursday morning, watching what was going on in the Ukraine. And it's hard not to have a visceral reaction to that. It's even the Russian soldiers that you're seeing. Something like 3,000 of them have perished. That's someone's husband, brother, father, son. The loss of life is going to be extraordinary, and the amount of displacement that's going to happen, that we saw those long lines trying to get into Poland, trying to get out of Ukraine. I mean, that's going to have an effect on you as a human, and it should. That's what makes us humans. But what it also can do, the downside to that is it can tend to cause us to overreact and to place too much emphasis as an investor, not as a human, as an investor, on trying to, well, I've got to do something because this thing is going on in this faraway area and I'm seeing these images and it just looks really bad. And to your point about the market discounting, the market always being a discounting force, looking forward, they were able to see through the initial shock of, again, something in Europe, a country in Europe being invaded for the first time since the 40s. Hasn't happened in 75, 80 years. And take a look at that and think, okay, well, what is Russia's impact on the global economy? Well, what is Ukraine's, what is Ukraine doing? And what they saw and what the market saw was that, things didn't fall apart. The Ukrainian resistance kind of held up much better. International response has been united. It hasn't been, they've been able to put a united front up against it. And all of a sudden things don't look as bad. And it's not to say that we're not going to see more volatility. But in that moment, you can take those images that you saw overnight on, pick, Fox, CNN, MSNBC, Bloomberg, CNBC, whatever news outlet you're watching. You can get you see those images, and then you see the big red, NASDAQ down 3%, Dow down, 700, 800 points, and you'd be like, well, I got to get out of this market. I got to reduce some risk. And what you would have done is you missed, basically a 4% swing to the upside in the aggregate. No more than that. It finished up 4% Thursday and Friday combined. But if you sold at the lows, you lost something like 700 or 800 basis points of kind of potential performance or appreciation if you sold at the lows. So I think
regardless of trying to get the trade right in this last week, right? I mean, even if we zoom out and for our clients, we would have a plan in place, right? An investment policy statement. We would have a plan and a structure for how we're going to manage our assets. Let's conclude that for the audience. When we get into correction or bear market territory, historically speaking, these have been long-term, and let's put a number to long-term, at least 3 to 5 year horizon, right? From the entry point, say now, theoretically, 3 to 5 years in the future. Historically, these have been attractive entry points. Maybe in closing for the audience, how we think about that. Are you putting it all in at once? Do you nibble on the edges? How do you think about that? And again, with the basis that you're a long-term investor, because I think we've highlighted everything that's changed in 2 months if you tried to put a projection together. So admittedly, I am not a very good short-term investor because I'm just not smart enough to be able to see all this and capitalize on it in the moment.
Yeah, I think that our philosophy first and foremost, again, is I think to have these diversified portfolios, which is going to give you the ability to kind of weather these storms. So it gives you the option not to do anything. You can just you can weather these weather this volatility. But what I would say is that if you're a long-term investor, typically times like Thursday morning is probably the best time to put money to work if you have a long-term time horizon. I think most 10% corrections. If you look out a year and you were to average every time the market corrected 10%, what were the average forward-looking returns? I think the average return was something like 17% from the down 10%. So not, up 27% to make all the down plus the up, but just, a 17%, point to point performance. So if you're willing to take a longer term perspective, these inflection points where there's a lot of uncertainty, there's a lot of negative sentiment, and there's a lot of human reacting without having full knowledge of a situation. Those are really good times.
Don't we see in these instances, hey, I'm going to sell, and then I'm going to figure out what happens, and maybe I'll come back in and buy, right? I mean, I'm going to sell first if I think of capital markets.
Right, yeah, and that's what happened. And then it's like, well, when do you get back in? Because if you'd have sold at 9:35 in the morning on Thursday, you looked like a genius. And by 3 o'clock in the afternoon, you looked not very intelligent. And that's what makes swing trading and day trading so hard for us long-term investors. Putting a little bit of capital to work on Thursday morning, if it fits with your investment policy statement, if it fits with your risk tolerance, and you're willing to say, all right, I'm going to, take that 0.5% or 1% of my portfolio. I'm going to buy.
I'm going to lean in
whatever
a
it is.
bit.
I'm going to lean. I'm going to lean just a little bit.
Right.
You're going to be historically. You're going to be really happy that you did that. Why is that? Because it never feels good in the moment to put money to work when things are that uncertain and you're already in a correction. And at that point in time, where everything inside of you is saying sell, that's when you got to buy. And it's not to say that the market can't go down even more. And if it does, you have to be prepared to potentially allocate, incrementally a little bit more capital.
But maybe that's the final point for the audience, right? The buy, you're only buying because you've got financial clarity, you've got a plan in place. I want X in domestic, I want Y in international. I've gotten a little light, right? But there's got to be a whole parameter to this, because otherwise, if you're just buying without a plan, this gets really hard to be able to buy in these moments of extreme uncertainty. Would you agree with that?
Yeah, you absolutely have to buy with a plan. You have to understand kind of what rebalancing is, and you have to understand that no one's ever going to time it perfectly right. And let's just say that on the off chance that you timed it perfectly right one time, the chances of you timing it perfectly right the next time are not very good. So you just constantly have to be in this mindset where I'm going to take advantage of volatility if it fits with my risk parameters, and I'm going to sell whether it's the core fixed income or the real assets, I'm going to sell a little bit of that. Or if I have cash on the sideline, put a little bit of that cash to work, knowing that I might have to come back in and put more cash to work because something else might happen. China might see what's going on with Russia and Ukraine and think, well, hey, maybe we want to take a peek into Taiwan. Not to play geopolitical chess, but there are a lot of other situations out there that we can't possibly predict. And so putting capital to work within the confines of your IPS, putting a little bit more into domestic, topping it up, you have historically been rewarded for stepping into the breach, for stepping into markets when it's been really uncomfortable. And it's that being uncomfortable is the reason you're getting that price, right? There's a lot of people selling. You want to step in and buy, you're going to be compensated for taking that position because everybody else wants to get out. You want to take a step in and get in, and then historically you've been rewarded for that over time.
So maybe in closing for the audience, look, there is a tremendous amount of uncertainty. It is playing out on a daily, weekly basis at this point. To the extent we would encourage you to reach out to your advisor and have a discussion. And to the extent that you've got that plan in place and you've got that understanding, historically speaking, when markets go on sale by 10 and 20%, like we've alluded to, you zoom out the lens over a multi-year period into the future, these have been attractive entry points. It's not to say that markets couldn't deteriorate further from here. It's just saying being a disciplined investor has historically played out well. So Jason, thank you for coming on. And any final comments from you?
Yeah, I would just say that the last thing I would say is if you invested $10,000 on January 1st of 2000 through the close of the Wednesday's close, so February 22nd's close, you went through the dot-com bubble bursting, 9/11, the war in Afghanistan, the war in Iraq, the great financial crisis / real estate crisis, Greeks default on their sovereign debt, Portugal, Italy, Ireland, Greece, and Spain, European debt crisis. You had the energy cracking in 2015 and 2016, where oil went from $100 to $25 a barrel, and you had COVID, a 1 in 100 year pandemic. And that what
was the end date of that 20-year horizon?
So it was February 22nd of 2022.
And you saw the Bengals go to the Super Bowl. I mean, you've seen
we've seen a lot of stuff. Okay, Bengals almost won the Super Bowl, and that $10,000 invested.
I'm just saying they went to the Super Bowl. It's not.
They went to the Super Bowl. So we're not going to talk about it. But that same money, that $10,000 that was invested on January 1st of 2000, through all of those things that I just listed, including the Bengals getting to the Super Bowl, that $10,000 was worth $44,000 as of last Wednesday.
Pretty good return and pretty good reward for hanging through and hanging on during all of those events over a 2-decade period. Yeah, I think Absolutely. That's a very good closing point. So Jason, thank you for the insight, and we'll see the audience after first quarter, and we'll have another video for them.
Sounds good. Take care, guys.